people like exciting stories like the US Mag 7. They're easy to sell to clients. They're exciting. They're growing. They're new technologies. But normally, because of that, they get priced highly.
Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm very pleased to be joined today by Alex Wright. Alex is the portfolio manager of two of the UK's most popular investment funds, Fidelity Special Situations and the Special Values Investment Trust. He's well placed then to pass judgment on the state of the UK stock market right now, and as an avowed value investor, he can fill us in on how that approach stacks up in a world dominated by AI and tech. Before all of that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel, give us a like, join the discussion in the comments below. It really will help others find what we're doing here, and it means that you'll get new content as soon as it is released. That all said, Alex, welcome along. Let's start, if we can, with a snapshot of where UK shares are right now. Characterise the past year or so. What has been driving the really quite strong returns that we've seen?
Yeah, so it's been a great year in 2025 for UK stock markets. So the FTSE All Share, the main index, is up about 24%. And that's very substantial sort of outperformance of other markets, particularly the US. And I think the key driver actually has been sort of financial. So they're big in the UK index. They make up about 29% of the FTSE All Share. And indeed, their performance was up 39%. So that's been a real key driver, along with also some strong performance from sort of basic materials and industrials, which are other quite large sectors in the UK also.
Yes. And the funds that you run have captured all of that growth and more. And looking at different parts of the market at an index level, the largest companies, the FTSE 100, that's done better than the mid caps in the 250, which have done better than the small caps. Your fund both funds have kept ahead of all of that. How has it done that?
Yeah, you're right. So the market has very much been driven by those larger companies, with a big drag from the lower performance of the mid and the small caps. And actually, about 60% of my funds are invested in that smaller cap and mid cap part of the market. So actually, it's been great that we've managed to produce about a 25% return. So just greater than the market, despite having that big drag. And I think the key elements within that is a large weighting to banks, which have been particularly strong, where we've got about 15% of the portfolio. Also, some very strong performances from our stock-specific ideas in defence, which has also been a strongly performing area. We've had decent positions in Rolls-Royce, Babcock, Serco, and also M&A has been a theme. So we've had some bids in the fund, most notably Bakkavor and Just Group, which has also really helped performance in the more mid-cap part of the market.
And just further to that then, are there big parts of the market, certain sectors that you avoid in the fund, or that you're underweight?
So definitely that. Also, which has been a big help, is there have been some UK stocks, despite the overall market doing very well, that have done very badly in 25 that we haven't owned. So Diageo, I think it's the worst performer in the FTSE 100. We haven't had a position there. LSE is another one that's done particularly badly. And so it's not just sort of what we've owned, it's what we haven't owned that's been a real benefit through 25.
Yeah, and turning then to the UK versus the rest of the world, and particularly the US, have you seen evidence of a meaningful rotation away from the US? We've heard about this in the press, that it is happening. Has the UK benefited, and how much has it benefited versus other countries, would you say?
Oh, so clearly 25 was a really interesting year, because the US stock market meaningfully underperformed, with certainly in pound terms, UK index up 24, US index up 10. So that's a huge diversion. And that clearly shows that there are investors selling US stocks and buying UK companies. And that has happened not just for the UK market, but for other markets ex-US as well. So in fact, US performance has been one of the poorer performing stock markets globally this year. You wouldn't really know it from commentary, because most of the personal investor commentary still seems to be around sort of exciting US companies and AI. But actually overall US performance was quite poor relative basis in 25.
And so where does it all leave us as we begin another new year? Where have the gains left us in terms of valuations, for example, versus other markets?
Yeah, so I think what's interesting is for a long time, the UK market's been trading very cheaply, not just versus other markets, but also versus its own history. And so actually for the first time in 10 years, the UK now with that big re-rating that we've seen in 25 is now trading about average for its long term. So about 14 times earnings. Now, that compares very well to other markets, though. So other developed markets are more like 17 to 18 times if you look across sort of Europe, Asia. And then the US obviously stands out as being very expensive still on 24 times earnings. So I think certainly from a relative point of view, UK market still looks very attractive, although obviously absolutely you've had some really strong gains.
Yeah. And do you think there's anything fundamental in the UK market that accounts for that sort of lower valuation that we've seen, notwithstanding the fact that we've had a re-rating upwards in the past year or so? Is there something fundamental that means investors should always expect the UK to be on a bit of a discount versus other markets?
Well, as I sort of said, the UK isn't cheap versus its own history anymore. It's in line. So but it's other markets that look overpriced.
Yeah.
So
okay.
I think that's it. There's not a problem with the UK market, and the UK market I think is a sort of fair valuation overall. Now, obviously, as an active manager, we're looking to buy stocks which we think are more attractive than the market as a whole, and there is a lot of dispersion in the market, so we're still able to find value. But I wouldn't say that the UK market as a whole is particularly undervalued. So I think that's the interesting thing. There's Again, it's a bit of a myth. There's nothing wrong with the UK market. UK market performance has been good. It's been world beating this year. But actually, if you look at the long term, like 10 years, 10-year performance is in line with 30-year performance. So again, the UK market performance has continued to do what it's been doing. It's not a bad place to invest, and it's not performing badly. It's just you've seen, I would say, some exceptional gains in the US. But that has because that market's massively re-rated to what I would say is an unsustainably high valuation level.
Yeah, and talking of possible myths, what about value as an approach? There seems to be a sort of an idea, a sort of preconception that it's underperformed the growthier parts of the market. Is that true? Is it fair characterization? Is that too simple?
Well, that is also incorrect. Yeah, so value's been outperforming for each of the last 5 calendar years in the UK. And actually that phenomenon is also occurring in all markets globally with the exception of the US. So again, now, if you look over time, why do people like to call themselves value investors? That's because value stocks outperform. So that's not unusual. And it's because of the sort of behavioral characteristics, like people like exciting stories like the US Mag 7, that they're easy to sell to clients, they're exciting, they're growing, they're new technologies, but normally because of that they get priced highly. So everyone likes to call themselves a value investor, but very few people actually are value investors because they're seduced by these sort of high growth companies. And that's where you generally see the disappointment over time. And as I said, with the exception of the US, that's what is happening in markets globally. And you can particularly see that in the UK this year, where some very highly priced companies that we've already mentioned, like a Diageo or LSE, have derated from very high levels. But certainly in the case of something like an LSE, continues to trade over 20 times earnings compared to the market at 14, even after it's given up a lot of performance. It was over 30 times earnings. Wow. So that's again, another myth that there are no expensive companies in the UK. There are expensive companies in the UK, but they've done badly.
I see. And just finally, Alex, the government has talked a lot about trying to improve the sort of corporate environment here in the UK and to make it more attractive. Is that something that's really in the gift of government to actually achieve? Do you think there are changes they can make? Would you expect anything the government does to really have a material impact on the UK market?
Yeah, so there are things that you can obviously have specific tax breaks, as most countries do, which obviously, interestingly, the UK does not have anymore. And obviously, stamp duty is a negative for the UK market compared to other markets. That's a really anachronistic tax that used to be more widespread globally, but doesn't exist in most places. So there are those drags on the market that the government could sort of remove. I think it's sort of difficult to sort of actively promote a market, but you can certainly get rid of sort of impediments to investment.
Yeah.
I guess that said, it's not like the UK market has done badly. Like
Indeed.
if you look at what the UK market's done over, as I said, sort of over 10 years, it's more like sort of 7%, which is what it's done over 30 years per annum. My fund Special Values over my 10 years done 12% per annum. And I think we can keep largely doing that. So delivering sort of almost sort of 4% alpha per annum. And so stuff doesn't need to change, I think, both for the funds we run to perform, but also for the UK market to be a perfectly reasonable place to invest. So it's, again, if anything, sort of tinkering at the edges and doesn't really help.
Yeah. Okay. Well, look, we've covered absolutely loads there, Alex. So we'll leave it there for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means you'll get updated content as soon as it is released. Give us a like or share the episodes. It really will help others find what we're doing. That all said, Alex, thank you so much for joining us.
Thank you.